a man referred to by many as a financial genius, a champion of democracy, and one of the most powerful philanthropists of our time. But to others, he's an architect of global chaos, operating from the shadows to manipulate markets, shape global politics, and influence the fate of nations. George Soros, a man whose name sparks admiration, controversy, and countless conspiracy theories. From surviving Nazi-occupied Hungary to breaking the Bank of England and donating billions to promote human rights, Soros's life is a story of extraordinary success and relentless criticism. So stay tuned as we delve into the life of George Soros, exploring the origins of his wealth and power and uncovering the extent of his influence. Born in Budapest in 1930 as George Schwartz, Soros came from a well-educated Jewish family. His father, Tivadar Soros, was an attorney and an Esperantist writer, and his mother, Elizabeth, came from a family that owned a successful silk shop. During the 1930s, as Europe saw a rise in anti-Semitic sentiment, Soros's father decided to change the family surname from Schwartz to Soros. The surname Soros was chosen because it was a palindrome, which appealed to Tivadar, and because it had a meaning in Esperanto. In Esperanto, Soros means will soar, which was an optimistic nod to the family's hope for a better future amidst the challenging circumstances they faced. The most formative experience of Soros's childhood was the Nazi occupation of Hungary in 1944. To protect his family, Tivadar Soros secured false identity papers, hiding their Jewish background, and passing them off as Christians. George Soros, then only 14, was placed with a Hungarian government official, posing as his godson, which shielded him from deportation to Nazi concentration camps. As a 14-year-old boy, Soros would also experience the Siege of Budapest, a brutal military battle between the Soviet Red Army and Nazi Germany. The conflict lasted 50 days and resulted in mass destruction, starvation, and civilian casualties, all which Soros would witness firsthand. After World War II, Hungary was occupied by the Soviet Union, leading to the establishment of a communist regime. The political and social upheaval during and after the war deeply influenced Soros's views on freedom and democracy. In 1947, Soros escaped Hungary for England, aiming to start a new life and pursue his education in a more open and democratic society. Soros attended the London School of Economics, where he pursued a Bachelor of Science in Philosophy and was exposed to the teachings of philosopher Karl Popper. Popper's ideas on open societies and the fallibility of human knowledge resonated with Soros, shaping his philosophical outlook and future philanthropic endeavors. During his time at LSE, Soros faced financial difficulties and had to work various jobs to support himself, including as a railway porter and a waiter. These experiences instilled a strong work ethic in Soros from an early age. After graduating from LSE in the early 1950s, Soros sought a career in finance. Soros initially struggled to find a job in finance. However, he eventually leveraged a connection to secure a role at merchant bank Singer and Friedlander in London, where one of the company's executives was Hungarian. At Singer and Friedlander, Soros worked as a clerk in the International Arbitrage Division, where securities were simultaneously bought and sold in different markets to exploit price discrepancies between them. Working in international arbitrage exposed Soros to the intricacies of different economies, currencies, and political environments, and gave him a deep understanding of market mechanisms, liquidity, and pricing dynamics. After 2 years at Singer and Friedlander, Soros moved to the United States to take the next step in his career. His journey in the U.S. began in New York City, where after being rejected from dozens of investment firms, he managed to secure a position as an arbitrage trader at FM Mayer. This role allowed Soros to leverage his experience in international arbitrage, focusing on European stocks and securities, which were of growing interest in the American market due to Europe's post-war recovery. By 1959, Soros was eager to move beyond arbitrage and started developing his own investment strategies. After a 4-year stint at FM Mayer, Soros moved to Wertheim & Co. to work as a securities analyst covering European securities. This role allowed Soros to deepen his skills in evaluating stocks and other securities and develop his trading philosophy. It was during his tenure at Wertheim & Co. that Soros began to formulate his theory of reflexivity, a concept that would become central to his approach to financial markets. Soros's theory of reflexivity was built on some of the teachings of Karl Popper, which he'd picked up during his time at LSE. The theory challenges traditional economic theories that assume markets are always rational. Unlike traditional views that see prices as a reflection of fundamentals, reflexivity argues that prices can also affect the fundamentals, creating a feedback loop. For instance, if investors believe a company is doing well, they may buy its stock, driving up its price, which can then lead to real benefits for the company, such as cheaper capital costs. This in turn can improve the company's actual performance, validating investors' initial beliefs in a self-reinforcing manner. The theory emphasizes that market participants act based on their perceptions and biases, not purely on objective information. These perceptions can distort market prices from the fundamentals, leading to self-reinforcing cycles that can drive prices away from equilibrium, resulting in market booms or busts. Soros started to realize that exploiting these inefficiencies could be extremely profitable. By the early 60s, Soros was starting to grow frustrated at Wertheim & Co. He no longer wanted to work for other investors, and instead wanted to manage his own portfolio and put his theory of reflexivity to test in real-world trading. In 1963, after 4 years at Wertheim & Co., Soros joined Untold and Bleichroeder, a New York-based investment bank. It was here that he made a significant step in his career, transitioning from a relatively unknown research analyst to a portfolio manager specializing in international investments. At Untold and Bleichroeder, Soros was hired to manage investment accounts for wealthy American clients, focusing on international arbitrage and European securities. Soros now had more autonomy over his investment decisions, and he used this opportunity to test out and refine his theory. Soros was able to capitalize on post-war economic growth in Europe, however, was constrained by the firm's conservative investment policy, which prevented him from taking the aggressive, leveraged bets that would later earn him his reputation as one of the most successful hedge fund managers of all time. Soros craved even more independence to pursue his own investment strategies. He wanted to make highly speculative macro bets, something that a traditional merchant bank would not allow. His ambitions had outgrown his role. Soros was able to convince Untold and Bleichroeder to let him launch his own independent hedge fund, the Double Eagle Fund, whilst still working at the company. He put up some of his own money and leaned on his client relationships to secure $4 million in starting capital. The company saw it as a win-win. Soros had already demonstrated himself to be a strong trader, and none of the firm's own capital was at stake. By launching his own hedge fund within the confines of the Untold and Bleichroeder company, Soros was able to minimize the risk of going it alone. Instead, it would enable him to build up a track record as a hedge fund manager while still being employed and benefiting from the resources of the company. The fund was structured as an offshore hedge fund in Curacao, which unlocked tax benefits and fewer regulations, enabling Soros to pursue more aggressive trading strategies to amplify returns and outpace traditional mutual funds. The fund employed a global macro strategy, making bets on interest rates, inflation trends, and government policies by investing across currencies, bonds, commodities, and equities. This approach paid off quickly, and within just 4 years, the fund had tripled in size. Thanks to the success of the Double Eagle Fund and the confidence it instilled in him, Soros decided to leave Untold and Bleichroeder in 1973 and start his own venture, taking the fund's $12 million in assets with him. He established Soros Fund Management, an independent investment firm, and rebranded the Double Eagle Fund to Quantum Fund, inspired by the field of quantum mechanics, the branch of physics dealing with uncertainty, probabilities, and observer effects, a concept that resembled his own theory of reflexivity. Soros partnered with Jim Rogers, a talented analyst he had worked with at Untold and Bleichroder, who specialized in commodities and economic cycles. The pair worked well together. Soros focused on short-term market moves, whilst Rogers spotted longer-term macro trends. Between the years of 1973 and 1979, the fund grew from $12 million in assets to over $100 million, consistently achieving 40% plus annual returns and significantly outperforming most traditional investment funds. A notable trade in the early years of the fund was during the 1973 oil crisis. In 1973, the Organization of Arab Petroleum Exporting Countries declared an oil embargo on nations that supported Israel in the Yom Kippur War, which included the US, UK, Netherlands, and Canada. This embargo led to a quadrupling of oil prices by 1974, triggering global inflation, stock market crashes, recessions in many Western economies, and massive wealth gains for oil-exporting countries. Soros and Rogers were able to recognize early signs of an oil price surge before the embargo was widely anticipated and employed a multi-pronged strategy. Prior to the embargo being announced, Soros and Rogers built a large, long position in oil futures and energy stocks, influenced by their prediction that OPEC's growing power and political instability in the Middle East would cause a supply shock. After the embargo was declared, Quantum Fund also begun shorting US and European stock indices, led by their belief that higher oil prices would increase production costs and reduce corporate profits in Western economies. On top of this, the fund shorted the US dollar against the Japanese yen and Swiss franc, led by their view that the Japanese economy would adapt quicker to the oil shocks than the more oil-dependent US economy, and the Swiss franc would remain a safe haven during inflationary crises. Finally, driven by their thesis that high inflation would drive investors toward hard assets like gold and silver, the fund took long positions in various metals. Like falling dominoes, each of their positions drew in huge returns. The US stock market crashed, with the S&P falling nearly 50% between 1973 and 1974. Currencies of oil-importing countries weakened significantly, and gold and silver rallied. By 1980, Quantum Fund had made so much money that Rogers made the decision to retire at the age of 37. Rogers went on to pursue his passion for traveling and writing. After Rogers left, Soros continued managing the fund, scaling it from approximately $100 million to over $1.5 billion in assets under management in 1989. The fund's emphasis throughout the 1980s was on currency speculation and large-scale bets on central bank policies and government interventions. One of the high-profile trades during this period was the fund's Plaza Accord trade, which generated hundreds of millions in currency gains. The Plaza Accord was an agreement signed in 1985 between the US, Japan, West Germany, France, and the UK. The goal was to correct trade imbalances by making the dollar cheaper and other currencies stronger. Soros was able to predict the agreement of the Plaza Accord before it was officially announced through a series of observations. Soros's view was that the dollar was far too strong coming into the 1980s, which had led to American exports being overly expensive and uncompetitive, causing the U.S. trade deficit to reach $150 billion by 1985. Soros believed that the crippling conditions for U.S. manufacturers and the soaring trade deficit meant government intervention was imminent. Soros also paid close attention to geopolitical signals and statements. Prior to the accord, U.S. manufacturers and Congress were blaming Japan and Germany for their currency policies, claiming by keeping their currencies relatively weak, they were preserving an unfair trade advantage. At the same time, Treasury Secretary James Baker and Federal Reserve Chairman Paul Volcker had been hinting to the market that the U.S. was considering a coordinated effort to devalue the dollar to avoid a trade war. Soros pieced the dots together. Quantum Fund begun shorting the US dollar against the yen and Deutsche Mark and bought up yen-denominated assets. Once the Plaza Accord negotiations leaked to the public, Soros continued to add to his positions. By the time the agreement was signed in September of 1985, Quantum Fund had built up sizable exposure. Over the 2 years after the accord was signed, the US dollar plunged, and the yen and Deutsche Mark appreciated sharply, netting Quantum Fund hundreds of millions in profits. Another milestone for Soros during this period, outside of the success of his hedge fund, was the establishment of his philanthropic organization, the Open Society Foundation. The goal of this organization was to promote democracy, human rights, and open societies, particularly in communist and authoritarian countries, regimes that Soros had personally endured as a child growing up in a Nazi-occupied and later Soviet-controlled Hungary. Some of the first acts of the foundation involved funding underground democratic movements in Poland and Hungary, providing grants to Hungarian scholars, journalists, and civil rights activities, and even smuggling photocopiers into Eastern Bloc countries to help independent groups bypass government censorship. After the initial success in Hungary, Soros's foundation continued to expand into other Soviet-controlled countries, providing funding for opposition movements, media, and grassroots organizations challenging communist rule. The work of Soros's foundation helped set the stage for the fall of communism between 1989 and 1991, and in the immediate period after, the OSF continued to support Eastern European regions in their reformation. In recent years, the foundation has faced increasing backlash from the re-emergence of authoritarian governments, with Russia banning the work of the foundation in 2015 and Hungary forcing the foundation out in 2018. The foundation has also been the subject of intense criticism, conspiracy theories, and political backlash. Critics claim that Soros has been able to use his foundation as a vehicle to engineer financial crises, influence global politics, and profit from the chaos. Continuing down this rabbit hole could be the subject of an entire video. So let's leave it there and jump back into the rise of the Quantum Fund. By 1986, thanks to the success of Soros's Plaza Accord bet, Quantum Fund had grown to over $1 billion in assets, making it one of the largest hedge funds of its time. The success of the fund continued throughout the decade, navigating the turmoil of the 1987 Black Monday crash through short positions in U.S. equities and continuing to profit from Japan's market boom through long positions in Japanese equities. In 1989, Quantum Fund assets under management surpassed $1.5 billion, and Soros's personal wealth exceeded $1 billion, but he wasn't done yet. In 1992, Soros's fund made one of the most famous currency trades in history by shorting the British pound. By 1992, Britain was struggling economically. The country was experiencing high inflation with high interest rates, the housing market was collapsing, and unemployment was on the rise. At the same time, Britain was part of the European exchange rate mechanism, which aimed to keep European currencies stable before the introduction of the euro. The British pound was pegged to the German Deutsche Mark at a fixed exchange rate, and the UK had to defend this rate by keeping interest rates high and using foreign reserves. Soros could see the weakness in the UK economy and realized that defending the pound was unsustainable. The British economy was moving toward a recession, meaning high interest rates would be difficult to maintain. Germany had begun raising interest rates to fight inflation after their reunification, leading to the appreciation of the Deutsche Mark, and the Bank of England had only £44 billion in reserves. He concluded that if enough pressure was applied to the pound, the Bank of England would have no choice but to abandon the exchange rate mechanism and devalue the currency. Soros constructed his position by short-selling the pound, borrowing over $10 billion to do so. The fund simultaneously bought Deutsche Marks and other stronger European currencies as a hedge. Once other hedge funds and traders caught wind of Soros's trade, they too decided to bet against the pound, leading to more drawdown pressure. The Bank of England was forced to intervene, buying billions of pounds using foreign currency reserves and raising interest rates dramatically in a bid to attract investors. On a day now referred to as Black Wednesday, the Bank of England gave up trying to uphold the pound and left the European exchange rate mechanism. The pound fell over 15% that day, netting Quantum Fund over $1 billion in profit in a single day. Soros became known as the man who broke the Bank of England and reinforced his status as one of the greatest global macro traders ever. Soros was able to make massive gains thanks to his bold, high-conviction trades. But that same aggressive strategy also meant he took big hits when the market turned against him. 1994 marked one of Quantum Fund's worst years. The fund had built up a highly leveraged position in U.S. bonds, expecting the Federal Reserve to lower interest rates. However, to the surprise of the market, Fed Chairman Alan Greenspan decided to hike interest rates aggressively instead. In 1994, the Fed hiked rates 6 times, leading to a massive bond sell-off. As a result, bond prices plummeted, resulting in a $600 million loss for Quantum Fund. Soros's fund was able to bounce back through bets on Asian and Latin American markets, which were experiencing rapid growth from globalization. Quantum Fund also continued to thrive by betting on currency movements and central bank policies. However, much like what the UK had experienced in 1992, these bets came at the expense of certain economies. 1997 was an especially controversial year for Soros and his fund due to the instigating role they played in the Asian financial crisis. Throughout the 1990s, despite rapid economic growth fueled by foreign investment, Soros had started to identify signs that many Southeast Asian economies were unstable. At the time, many Southeast Asian countries had their currencies pegged against the US dollar. However, as the dollar strengthened in the mid-1990s due to rapid economic growth onset by the dot-com boom, Asian currencies started to become overvalued, making their exports relatively more expensive and less competitive. On top of this, many Southeast Asian countries had borrowed heavily from foreign banks to fund industrialization and infrastructure projects. As much of this debt was denominated in US dollars, repayments became relatively more expensive when local currencies weakened. Quantum Fund held the view that the Thai baht was the weakest of the Asian currencies, so they borrowed billions of baht from local and international banks and immediately sold it for US dollars, rapidly increasing the supply of baht in the market and forcing Thailand's central bank to spend its limited foreign currency reserves in an attempt to uphold the price and defend the US dollar peg. It wasn't long until more investors began withdrawing funds from Thailand, forcing the Thai central bank to deplete its reserves and abandon the baht's peg to the US dollar. The baht immediately crashed over 50%, making Quantum Fund's trade highly profitable. After the crash of the baht, panic spread across other Southeast Asian economies, and investors began shorting the currencies of Malaysia, Indonesia, and the Philippines. Eventually, these currencies also collapsed, triggering a region-wide financial crisis that wiped out trillions in market value across currency and stock markets. The meltdown led to mass layoffs, bankruptcies, and civil unrest in many countries, forcing the International Monetary Fund to step in with massive bailout packages. Leaders of the affected nations publicly blamed Soros and other Western speculators for deliberately destabilizing Asian economies for profit, branding him an economic criminal. 1998 was another rough year for the fund, suffering one of its biggest losses ever on a bet on the Russian economy. In the mid-1990s, Russia was transitioning from a Soviet-era planned economy to a market economy, but was still dealing with legacy issues. The economy remained highly dependent on oil and commodity exports, had high government debt, and was running a fiscal deficit, and the ruble was pegged against the US dollar with limited foreign reserves. Despite these economic weaknesses, Soros's view was that Russia's economy was stabilizing due to the introduction of privatization, foreign investment, and the restructuring of its banking system. Russia was also issuing government bonds with high interest rates of up to 50%, making it a way for the fund to earn high returns whilst betting on Russia's economic recovery. These factors led the Quantum Fund to invest heavily in Russian assets throughout the 1990s, including large purchases of Russian government bonds. However, in 1997, off the back of the Asian financial crisis, global oil prices crashed due to a slowdown in economic growth, which was a major blow to Russia, who were heavily dependent on oil exports as a source of government revenue. As a result, this weakened the Russian government's ability to service its high-interest debt, as well as maintain its currency peg to the US dollar. In 1998, the Russian government defaulted on $40 billion in domestic debt and had depleted their foreign currency reserves, forcing them to abandon their currency peg and devalue the ruble. As a result, Quantum Fund's Russian government bond position became worthless, losing the fund over $2 billion. The loss was a turning point for Soros, prompting him to rethink his investment philosophy away from high-risk emerging market bets to longer-term macroeconomic trends. Throughout the late 1990s, investors were rushing to buy shares of internet startups with the belief that they would dominate the future economy. Hundreds of technology companies went public between 1997 and 2000, raising billions, with many doubling or tripling in value on the first trading day. Investors began ignoring the fundamentals of these companies and became focused solely on growth and market share. It wasn't long before stock valuations became detached from reality, with companies becoming worth billions without making a single dollar in profit. This led to the formation of the dot-com bubble. Quantum Fund had begun investing heavily in tech stocks during the late 1990s, including companies like Yahoo, Cisco, and Amazon. Initially, the fund delivered high returns for investors as tech stocks soared. However, by late 1999, Soros became concerned that the market was in a bubble, and Quantum Fund began reducing their exposure. Between 1999 and 2000, the Federal Reserve began raising interest rates to slow down inflation. Higher rates made borrowing more expensive and led to the slowdown of investment into risky tech firms. As the growth of tech companies started to slow, investors began questioning their profitability, withdrawing further investment. As a result, many dot-com companies, which had high operating expenses but low revenue, started running out of cash. It wasn't long until institutional investors started dumping large positions, triggering market-wide panic and wiping out trillions of dollars in market value. Between its peak in March 2000 and October 2002, the Nasdaq had fallen 78% and the US economy entered a recession. Despite Quantum Fund's early precautions, they were still heavily exposed to tech stocks by the time the dot-com bubble burst in 2002. After the initial crash in 2000, the fund attempted to buy the dip, expecting stocks to rebound. However, stocks continued to collapse throughout the next 2 years, and the fund took further losses. Quantum Fund's total loss from the dot-com boom was over $3 billion, prompting Soros to fire his top fund managers for their miscalculations. In the years following the dot-com crash, Quantum Fund was able to rebound by becoming more conservative in its approach. The fund made hundreds of millions shorting the US dollar throughout 2002 to 2004 and made billions during the 2008 financial crisis by shorting US banks, mortgage lenders, and subprime bonds. The fund was able to deliver a 32% return in 2007 and a 10% gain in 2008, years that most other hedge funds suffered extreme losses. In 2011, Soros announced that he was returning outside investor money and was transitioning Quantum Fund into a private family office, marking the end of an era for one of the most successful hedge funds in history. Soros made this decision for a number of reasons. After the 2008 financial crisis, governments began imposing tighter regulations on hedge funds. The Dodd-Frank Act of 2010 was established, requiring large hedge funds to register with the Securities and Exchange Commission and disclose additional details about their strategies, holdings, and risks. Soros was against the idea of additional regulatory oversight, believing it would limit his fund's ability to make quick, large macroeconomic bets. By returning outside investor money, Soros could avoid these regulatory burdens. Markets had also grown more efficient in the 21st century, making Quantum Fund's arbitrage strategies more difficult to profit from. Hedge funds were beginning to enjoy greater success by shifting to quantitative and algorithmic strategies, including the likes of Renaissance Technologies and D.E. Shaw. With the advent of high-speed computers, and advances in data storage and algorithmic trading, price inefficiencies were acted upon faster. Thirdly, by 2011, Quantum Fund had endured a long history of making bold, high-risk bets, which had led to a track record of huge wins, but also major losses. In the years where bets didn't pan out, Soros had been thrust into the global spotlight, publicly bashed, and put under extreme pressure. By transitioning to a private family office, Soros no longer had to justify performance to investors and could continue to have flexibility in his investment decisions. Finally, by 2011, Soros had already donated around $11 billion to his Open Society foundations, and by transitioning to a family office, he could devote more of his time and resources towards philanthropy. Soros could now fund political and social causes without investor interference and could become more outspoken on global politics and climate change initiatives. In 2023, at the age of 92, Soros officially handed over control of Soros Fund Management to his son, Alex Soros. Soros chose Alex over his other 5 children due to their political alignment, with Alex initially joining the foundation in 2010. Upon stepping into the leading role, Alex Soros has reaffirmed his commitment to progressive causes, including the protection of democracy, human rights advocacy, and climate change initiatives. The investment strategy of the family office remains long-term investments, but the focus has been directed toward green energy, technology, and social impact investing. George Soros's life is a testament to the power of ambition, intellect, and resilience. From surviving Nazi-occupied Hungary to becoming one of the most successful investors in history, his journey has been marked by bold financial bets and transformative philanthropy. His Quantum Fund went head-to-head with governments and central banks and reshaped global finance, while his Open Society foundations have funneled billions into promoting democracy, human rights, and economic justice worldwide. Whether seen as a visionary or a disruptor, his legacy is one of immense impact, shaping both financial markets and the geopolitical landscape in ways few individuals ever have.